What is the 4% rule of retirement spending? How do low interest rates affect your retirement plans? And how can a government website help you with your finances? We'll answer these questions and more on this, the 46th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 46th episode of the DoughRoller Podcast. We have a great show for you today. We have on the show Maria Bruno and Colleen Jaconett. And my guess is you're asking yourself right now, who are Maria and Colleen? Well, they are retirement experts. Actually, they have a lot of credentials. You'll hear from them in a minute. And they work at Vanguard. I wanted to bring some more retirement savings, retirement planning content to the show. And I thought, well, why not go to the experts? So I reached out to Vanguard and I said, do you have folks there that can help us with some retirement questions who would be willing to come on the show? And they said, absolutely. And so Maria and Colleen will be on the show in just a little bit, and I think you'll find their insights to be very helpful. I hope you benefit from it. And they did a great job. It was great to have them on the show. Before we get to that interview, though, let's hit the money tool of the day. And this one may surprise you a bit. It's a government website. Yeah, I know, a government website. Turns out it is an absolutely great resource for a lot of reasons. And the website is consumerfinance.gov, consumerfinance.gov. That is the website for the Consumer Financial Protection Bureau, a fairly new government entity. They go by the CFPB for short. And if you check out their website, there is a ton of information that will help you in a number of ways. I'm going to cover 5 things this website can help you with. But just quickly, by way of background, the CFPB is a government organization that's basically designed to protect consumers in all things related to finance, whether it's protecting consumers vis-a-vis credit card companies, banks, payday lenders, prepaid cards, mortgages, all that sort of thing. And that's what they do. And so what's so good about their website? Why is it the money tool of the day? Well, let me give you 5 reasons. The first is, if you go to the website, again, it's consumerfinance.gov, you can file a complaint. You can submit a complaint. If you have a complaint against a mortgage lender, a bank, a credit card company, a payday lender, whatever, you can submit a complaint right on the site. Your personal information is all confidential. The interesting thing about their complaint system is that the financial institutions actually take this seriously, and they respond to these complaints. And sometimes the complaints result in compensation to the individual, the consumer who's issued the complaint. You can actually see some data that the CFPB makes available about their complaints. Again, no personal data, so you don't have to worry about that. But it does publish some sort of, I call it generic data about all of the complaints filed, including who they're filed against, and also whether the company, the finance company, credit card company, bank, what have you, whether they've responded to the complaint and what that response was. Again, not in any personal information, but at a high level. So these companies take these complaints very seriously, and they obviously don't want to be listed in the database as not responding to these complaints. So, I always think the best way to deal with issues is first directly with the entity, the bank, the credit card company. In my experience, I've found that I can get an issue resolved directly with the finance company. But if you can't, you can submit a complaint through the CFPB. That's the first thing that it does. The second thing is it has some great resources on paying for college. If you go to the homepage, you'll see it right there. There's a link, Pay for College, and they have a number of tools that you can use that will actually walk you through how much college will cost and the different ways, whether it's a GI Bill, if you're we're in the service or financial aid. You can input your specific college and information about tuition and costs, and it help you choose a school in terms of costs. It's a great resource. Again, I think when you're thinking about paying for college, it's certainly not the only resource you want to use. But I think a lot of people don't realize that the CFPB has this information on the website about paying for college. It's definitely worth checking out. That's number 2. Number 3 is mortgage help. There's a lot of information on help with mortgages, including issues when you get to a point where you can't pay your mortgage. And so there's information on your options and resources that you can use if you find yourself in that situation. They have resources for home buyers. Maybe you don't own a home yet, but you want to. And they have some great information for home buyers. And of course, like I mentioned, the complaint system. You can file a complaint against a mortgage company if you need to. They have resources on finding housing counselors. They have checklists for homeowners, checklists for ways to avoid foreclosure. I mean, it's just a wealth of information on mortgages. That's the third thing. The fourth thing is, similar to mortgages, they have a ton of information on help with credit, about getting your credit report for free, checking your credit score. Again, you can submit complaints against credit-related entities, including the credit bureaus. Again, I always think it's best to go directly to them first, but that option is available to you. And so just a ton of information on credit reports, credit scores. The fifth and final thing I want to mention today, and this is by no means all of the information on this site, but the things I wanted to highlight is they have a section called Ask CFPB, and it's a great part of this website. And what you can do when you go to this section of the website, you can ask a question, and there's a little box where you type it in, and what it does to begin with is simply search the website for articles related to your question. And it's a great way to find a ton of information on this website. But here's the thing that's really interesting. What if you don't find an answer to your question? Well, you can actually submit your own question directly to the CFPB. And a lot of users have done this. And so if I would search their website first with this Ask CFPB tool. But if you don't find the answer you're looking for, you can submit a very specific question to them. And as part of this, and again, I'll leave links in the show notes to this, but as part of the Ask CFPB page, they also have categories. And you can click on a category, for example, auto loans or student loans, or I'm looking now at one for prepaid cards. And it will sort for you all of the articles on CFPB about that topic. And a great wealth of information. And I think a very, very helpful tool to consumers. So there you go. That's the money tool of the day. The Consumer Financial Protection Bureau's website. You'll find it at consumerfinance.gov. So with that, let's turn to the interview with Maria and Colleen. Again, they're both from Vanguard. Hope you enjoy the interview. Hope it proves to be very helpful to you. Here we go. Maria and Colleen, welcome to the show.
Thank you, Rob.
Hey, I'm thrilled to have you. I'm thrilled to have you both here to talk about retirement and retirement investing and spending. Before we jump into it, though, could you guys just give me a little bit of your background? Maria, perhaps we could start with you.
Sure. I am a senior investment analyst with Vanguard's Investment Strategy Group. I am also a certified financial planning professional. So I've worked with financial planning clients for well over a decade. I've been in the financial services industry for over 20 years, but a lot of the work that I've been doing has been around financial planning strategies, particularly with retirement planning and retirement income strategies.
Great. Colleen?
Yes, I too am a senior investment analyst in Vanguard's Investment Strategy Group. I've been with Vanguard for over 15 years. I'm also a certified financial planner as well as a certified public accountant. And my primary focus has really been working on the advice methodology at Vanguard, specifically focusing on retirement income.
Well, you two are the perfect folks to talk to about retirement. And again, I'm thankful for your time. So I get a lot of questions from listeners on the topics we're going to cover. And obviously very important topics for folks' financial future as they get near retirement and then enter retirement. So let me jump right into it. And I want to begin with a very, I think by now, very popular rule of thumb, and that's the 4% rule of retirement spending. Can you guys just sort of, to start, describe for us what that is?
Sure. So the 4% spending rule is really a rule of thumb, and there's been a lot of researchers who have done work around this, Vanguard included. Both Colleen and myself have done work on this. And what it sets out to do is set out to do a guideline for individuals who are starting out at retirement, to give them a framework in terms of what a sustainable portfolio spending rate could be throughout retirement. So there's a couple factors that come into play, one being the asset allocation. So most of the studies out there, including ours, assumes a balanced portfolio, anywhere from 40 to 60% equities. And what we do is we run simulations. We look at Monte Carlo, in our situation, we do Monte Carlo simulations, and we look at different risk-return horizons. And 4% seems to be a good starting point to give a strong likelihood for the portfolio not being depleted over a 30-year time horizon. So I think when we talk about the 4% spending rule, two factors come into play, which are paramount. First is the asset allocation, and the other is the time horizon. And I bring that up because I think there's a lot of focus on the 4% spending rule of thumb, but you need to keep in mind around time horizon. So, for instance, if you have someone who's starting out retirement much earlier, say in their 50s, then they would want to err on the conservative side and maybe have a lower initial withdrawal rate, maybe of about 3%, for instance. On the flip side, someone who perhaps is in advanced retirement, maybe in their 80s, they shouldn't necessarily be tied into a 4% spending rule. So there is flexibility around that. I think we'll use that term a lot during today's discussion, but it's meant as a starting point. And there's been a lot of interest in this figure in today's environment because of the low yield environment and the recent global financial crisis as well. So there's a lot of interest in this figure. It is a rule of thumb. We at Vanguard do believe that it's still a viable starting point, but there are a lot of factors that come into play when thinking about that figure.
Okay. Well, let me put some actual dollars on this. So if someone had a portfolio for retirement of $1 million, then under the 4% rule, in year one of retirement, they could withdraw $40,000.
Right. So the way it would work, it's a dollar inflation adjusted formula. So in that situation, $1 million, the initial spend would be $40,000. And then you would adjust that spending rate every year thereafter for inflation. So that's one of the cautious areas of this rule of thumb, in that it is meant to provide a predictable income stream throughout retirement because it's inflation adjusted. So rather predictable. But what it doesn't do is it does not look at market performance. So it totally ignores the portfolio value. And that's where the tail risk is, or the real concern around this type of spending strategy, because theoretically someone could be increasing their spending throughout retirement, but if they incur a sustained bear market, particularly in the early stages of retirement, that's when the portfolio runs the risk of being depleted prematurely.
Right. That's a key point. The 4% rule is that determines your initial withdrawal in year one. But as you say, you then, at least under this rule of thumb, there's no rule that says a retiree, of course, has to follow this. But if you were, you would then adjust your withdrawals, presumably increase them each year by the rate of inflation. And if I understand what you're saying, the tail risk, I think you described it, is you could be increasing your withdrawals at a time when, say, the market is down 10, 20, 30, 40% in a year. And so your portfolio balance is going down significantly while the amount you're taking out is still ratcheting up a little bit each year, and that can create the risk that you run out of money during retirement. Is that the idea?
Right. So, for instance, the global financial crisis, for instance, if that was sustained and someone had not altered their spending, what they thought was 4% could potentially be 6%. And clearly a portfolio that's meant to last for 30-plus years could not sustain a 6% withdrawal rate. So it is important to do a cross-check against the portfolio just to validate that. On the flip side, there's also a percent of portfolio spending method, which is exactly that, where you take the portfolio, say, every year. And if your spending rate is 4%, you would take 4% of the prior year-end balance every year and presumably spend that. Now, technically, you could never run out of money because it is a percent of portfolio, although the dollar amount could get much smaller over time. what the trade-off there is, it results in a very volatile year-to-year withdrawal strategy because it is very contingent upon market performance. So that's another method, but that too then comes with the trade-off of having volatile income where many retirees wouldn't be able to live with that type of volatility.
Yeah, it's like there's
and
no...
when I say volatility,
Go ahead.
the volatility of the income stream. Mm-hmm.
Right, you're right. So under that sort of approach to the 4% rule, rather than starting out with a dollar amount that's equal to 4% and adjusting for inflation each year going forward, you simply take, let's assume 4%, it could be something else. You simply take 4% of your portfolio each and every year. So if it happens to be a good year like 2013, you're going to presumably withdraw a lot more than you did the previous year because the market, at least the S&P 500, was up, 32%, I guess. But in a down year, like I guess 08 and 09 time period, you could end up taking out a lot less. So you have a lot of volatility in your spending from year to year.
Right, and that's where we think retirees will have trouble with. The upside is great because you have surplus. It's those years when the market is not performing well, and you might need to ratchet down that income, and that's where retirees may have trouble with this type of, strictly following this type of method.
Right. Well, Colleen, I think you've written about, I guess, a third alternative, which is, if I've got it right, is a percentage of portfolio, like you've just described, except that you put in place a ceiling and floor. Do I have that right? And can you explain how that would work?
Sure. Yeah, so we kind of dubbed this the hybrid method. So we try to take the two strategies, the positive parts of each of these strategies. So each year you would spend 1% of the portfolio, and you could actually increase it maybe up to, say, 5% due to the fact that you are actually having some flexibility with your spending. So you could spend a little bit more. So again, you would take 1% of the prior year end balance, but then you would make sure that falls within a ceiling and a floor. So you would kind of put a range on it. And the reason why the range is helpful is because if you had a really good year and say the market was up 33%, you would cap the amount of spending, the amount you're spending would increase, so that in other years when the market maybe goes down, you would not have to cut your spending as much. So it helps with the predictability of the income stream and not having it as extreme highs or lows as far as the spending amounts each year.
Do you have, in the research you've done, is there any sort of guidelines you can give us as to what the ceiling should be and what the floor should be? I take it those are percentages?
They are percentages. So we, and it's the year-over-year change in real spending. So what we're trying to do there is keep the spending numbers within a range. So we would say each year the spending would not increase by more than 5%. So if the market was up 15, you would increase your spending from year 1 to year 2 by 5%. And that extra 10% of the return would go in the portfolio. And then we would also say then your year-over-year spending would not go down by more than 2.5%. So if the market was down 5% or 10%, you would actually only be cutting your spending by 2.5%. So when you're thinking about that, it is important to realize it's the year-over-year change in real spending.
Okay, and it sounds like what the idea there is to combine the first two approaches, the sort of traditional 4% rule where you adjust for inflation, and just taking 4% every year. Combine those two with a ceiling and floor, so you kind of get the advantages of both, and you minimize the downside of each, even though, again, nothing's perfect, but it kind of puts in place some parameters that makes the volatility from year to year a little less painful.
Yes, exactly. And if you look at it, if you have a zero ceiling and a zero floor, you essentially have dollar plus inflation. And if you went out to something more like a 10% ceiling and a 10% floor, it would be very unlikely that the ceiling and floor would kick in. So you would actually essentially have percent of portfolio. So it's somewhere in between there is where the benefits of the ceiling and floor would really kick in.
Right. Well, let me ask you one question. One thing that I don't know if it was you or Maria, but you alluded to the fact that bond yields are low and dividend yields are low. I'm curious, how do you think, for those nearing retirement, in retirement, or even those maybe decades away, but they're trying to plan for how much they need to save, how should sort of the low yields that we're seeing now, and I think some predict going forward, we'll see, eventually interest rates have to rise, you'd think, but does that have any impact on this 4% rule and how folks should plan for retirement?
Well, I would say that it doesn't really impact how you should plan for retirement because we believe in following more of a total return approach. So we don't focus solely on the income. So what we would say there is that if an investor is in retirement, they should not let the yield or the cash flow from the portfolio dictate how much they can spend. So, for instance, in 2013, say a 50% stock, 50% bond portfolio, the yield was only 2.5%, but the total return of the portfolio was actually about 15.5%. So what we would say is, once you spend that 2.5%, you should actually maybe dip into the 13% to meet your spending needs, as opposed to changing the composition of your portfolio to get that yield number to be higher.
And let me break that down a little bit, make sure I'm following you. So obviously with bonds, when you talk about yield, you're talking about ultimately the interest payments that an investor receives.
Correct.
And I take it for stocks, then when we talk about yield, we're talking about the dividend payments they receive, whether it's from an individual stock or even a mutual fund.
Yes.
Okay. And so in a 50-50 split, that is 50% bonds, 50% stocks. Was this last year you said? Was it 2.5% yield?
Yes. And that's been coming down since 1960 through, the current years. Each of the last, say, 5 to 7 years, the yield on a 50-50 has been well below the 4%.
I was reading one of the articles. I think, Colleen, you wrote it, but I may have that wrong. But I think it was back in 2007. And in the article, there were yields. And I know the 100% bond portfolio had a yield of, I want to say, 4.5%. Now, of course, this was 2007. And I thought, man, I'd love to have bond yields at 4.5% right now. It is unbelievably low.
Yes, it is.
And so when you talk about a total return approach, you're saying, okay, don't focus just on the interest from bonds or the dividends from stocks, but look at a total return, which would include capital appreciation.
Exactly.
The value of stocks going up.
Correct. And what that really does for you is a lot of people, when they're looking at their portfolio and trying to figure out how to get meet their income needs, if they only focus on the income, they might change their portfolio to overweight dividend-paying stocks or high-yield bonds, so maybe give up some diversification and increase the risk on their portfolio. So in their fear of not spending from principal, they could actually make changes to their portfolio that would put their principal at higher risk than simply spending from it.
Yeah, and for the total return approach, I mean, you really have to have a significant portion of your assets in stocks, right? Because, I mean, there's...
Well, we would say a balanced portfolio, so, at least 50% in stocks.
Okay.
For a retiree, with a longer time horizon, say, 20 to 40-year time horizon, a 50% stock allocation could be very reasonable.
Okay. So, because the thought is you're more aggressive early in life, in your 20s, 30s, 40s, whatever. And then as you get closer and closer to retirement, you tend to put more in bonds and less in equities. And so, but you're thinking that a balanced approach, again, it's going to vary from person to person. I know there's no one right answer, but you think a 50-50 split between stocks and bonds is at least a good sort of rule of thumb or starting point for those in retirement?
Sure. I would say, even between 40% in stocks and 60% in stocks, just because it's important over longer time horizons to have some of that growth on the equity side of the portfolio to keep pace with inflation, as well as, grow to support the spending needs through time.
Let me ask you about this. I'd read an article on CNN it was an interview of Michael Kitces, and I'm pretty sure I've got his last name spelled right, Kitces. I think it's Kitces. That's how he pronounces it. And he had done some research and suggested that in your first few years of retirement, you really should be conservative, because how your portfolio performs in, say, the first 5 to 10 years is critical to whether or not your portfolio will be enough to provide for your retirement. And so he suggests starting with perhaps more bonds than stocks early in retirement, and then as you get a number of years into retirement and the time risk minimizes somewhat, obviously your time in retirement goes down, then you can start to get a little more aggressive in your asset allocation and actually then move more into equities. And I'd never heard of that approach before, and I'm curious, are you familiar with that, and what are your thoughts?
Yes, Rob, we do get this question periodically, and sometimes it's referred to as a U-shaped glide path, in that during your accumulation years, you're more aggressive, and then as you enter retirement, you move more conservatively, say 20 to 40% equity, but then you ratchet that back up to 40 to 80% equity later in retirement. And the notion there is that, the advocates will say that this should provide for higher success rates, meaning that it reduces both, but it also reduces the probability and the magnitude of the failure of the probability of losses. Now, while you can think about that, but if you think about it intuitively and you think about retirees, basically what this does is it shifts the sequence of returns risk from the beginning of retirement, this tail risk that we talked about earlier, to later retirement. And it can create some pretty serious, in my opinion, some pretty serious market risk scenarios for retirees. It would be very difficult to address these type of market risk scenarios with someone who maybe is in their 80s or 90s. Earlier in retirement, if you're facing these types of bear markets, for instance, that we talked about, you have the ability to adjust. Maybe you can adjust, maybe, doing some work part-time or consulting, or maybe cut back on discretionary type expenses. But in advanced retirement, it becomes very difficult to manage this type of tail risk. If you can envision 2008, where a 70% portfolio lost maybe about 20-25%, if you're having a discussion as a financial planner or working with a client who's in their 80s and having this conversation, it's very difficult to deal with that situation versus someone who may be balanced in 30% equity, for instance, and in 2008, they would have lost less than 10% of their portfolio value. So, in our opinion, it really shifts this return risk towards the late stage retirement in a period where it's difficult for retirees to be able to adjust with that.
Yeah, and that actually is a good point. That I think we tend to think of retirement as one chunk of time. You're either working or you're retired. But the reality is, retirement at age 65 is going to look a lot different than retirement at 90. Both in terms of your spending needs, your as you said, your ability to perhaps adjust. You're going to have presumably more options at 65 to adjust to perhaps a difficult market, for example, than you will when you're 85. Again, every circumstance is different, but I think it is one of the mistakes that I know I make sometimes, is thinking of retirement as all the same, and it's not. In fact, your spending requirements will change. Likely change significantly over a 20 or 30-year retirement span. Do you agree with that?
Yes, absolutely. And I think it's a good practice for people who are entering retirement or early in retirement to really look at their spending from both a discretionary and non-discretionary standpoint, meaning non-discretionary are things that you need to spend: food, housing, income taxes, healthcare costs, whereas discretionary are things like leisure, travel, because that'll shift over time. So perhaps somebody earlier in retirement might have more goals in terms of travel and leisure, so their discretionary expenses might constitute a greater percentage of their overall spending. But as perhaps you advance into later retirement, what often is seen is that the discretionary expenses go down, but the non-discretionary, typically related to healthcare costs, may go up.
Right.
So there's a fluidity there, and I think by looking at the expenses between discretionary and non-discretionary can give a retiree a good sense of where they may be able to make adjustments if they need to.
Yeah, the other thing, and this is just my own personal view of investing, that I was concerned about this approach, this U-shaped approach. He calls it sequence risk, I think. This risk that you're going to have bad years in the first few years of retirement. And it is a real, would you agree that is a real concern? If you have bad market years in the first couple of years in retirement, that does have an impact on your success rate. That is, that your money will be sufficient for your years in retirement.
Yes, absolutely. And the other thing to keep in mind is, at Vanguard, we really advocate for all investors, regardless of what life stage they're in, to really focus on the things that they can control. So as investors, we can't control the market, but what we can control are things like our asset allocation and making sure that we do the portfolio management tactics such as rebalancing to that asset allocation. So we basically will manage the risk profile of the portfolio. Also, investment costs. We've talked about a lot of simulations and research here. We need to overlay also real-life considerations in terms of costs. Costs be investment costs as well as taxes. So focus on the things that you can control as an investor, because it'll make you much better equipped to deal with the things that you can't control. So none of this is once and done. Once you've spent your your spending target and your asset allocation, it's very important to revisit that at least every few years, if not to adjust the asset allocation, but at a minimum to rebalance that periodically.
Mm-hmm. Well, let me cover both of those. On the portfolio construction, do you think, the Michael Kitz's approach is making changes to your asset allocation during your retirement years? So putting that aside, though, apart from rebalancing, which of course it doesn't involve, it changes your actual asset allocation, of course, but it doesn't change your plan, right? You're conforming, I guess, your actual investments with your plan when you rebalance, right? Do you think there's a need to actually change your asset allocation during your retirement years?
Well, really, we would say life changes, like not market changes, would drive someone's allocation. So I would consider retirement a life change where you should at least look at the asset allocation and see if you think you would like to become more conservative due to the fact that you no longer have income coming in. So a lot of people, upon retirement, maybe they thought about it up until retirement. Well, if I did lose money in the market, I could replace it with my salary. So it might be a point of time where people should just take a few moments to think about the fact of, given that, I'm no longer going to have income, would I want to become more conservative? And not necessarily would they have to, but it's just kind of a consideration. And then throughout retirement, investors may decide to become more conservative as their time horizon shrinks. So as Maria was talking about before, you may not be able to recover from a 30% loss or a 20% loss. So sometimes through time, investors may say that they would prefer to become more conservative as their time horizon decreases.
Mm-hmm. Yeah, it's interesting on the conservative and aggressive because, that discussion is always stocks versus bonds, although, and maybe I follow Warren Buffett too closely, but, there are other risks besides volatility, right? I mean, for example, the risks that you won't increase the purchasing power of your capital, which is a huge risk for bonds, at least in my view. Although, as you say, when you're in retirement and your time horizon's getting shorter and shorter, there may be other considerations that trump that. And as you said, there may be times when you want to adjust your asset allocation, and that certainly makes sense. You mentioned investment costs. I'm curious, and that's something, by the way, those listening know I harp on investment costs all the time. But I'm curious, how do investment costs affect the 4% rule, whichever version of it one follows, and the likelihood of success, that is, the likelihood that you'll have enough money during retirement? Is there a relationship between that and investment cost?
Absolutely. So when we run our simulations, and we put out there that say you could spend 4% over a 30-year horizon at a 50-50, that assumes you pay all costs and taxes from that 4%. So depending on how you want to look at it, that would really mean you could spend something closer to 3.75% or 3.5%, depending on, whether all of your assets are in a tax-deferred account where you'd pay ordinary income tax on them or a tax-free account. So the amount of investment costs and taxes, is a dollar for dollar reduction in the actual spending for investors.
Okay. Well, let me focus. The taxes are what they are, right? Let me focus on the cost for a second. Let me play devil's advocate because I get this question a lot. They'll say, well, the cost of a fund isn't really the issue, whether it's a low-cost Vanguard fund at whatever, 15, 20 basis points, whatever it might be, versus, say, 100 basis points or more for an actively managed fund. That's the wrong thing to focus on. What you should focus on is your after-cost returns. And if you have a mutual fund that's charging you 1% or 1.5%, but it's beating those low-cost Vanguard funds, isn't that really what you should focus on? And aren't those the funds that you should be buying, focusing on after-cost return, not the expense ratios? What would you say to that?
I would say you should absolutely focus on after-cost returns, and if they know in advance which funds will provide the highest after-cost returns, then that would be, ideal. The problem is no one really knows that in advance, and actively managed funds as a whole, after you take costs into account, there's no predictability as far as would those provide higher after-cost returns.
Yeah, that's great. I cringe at those articles that you read where they talk about those funds that have beat the indexes over 10 years. And I think, that's easy. That's an easy article to write when you're looking in the rearview mirror. Now, how about the 10 funds you think are going to beat it in the next 10 or 20 years? That's a much harder article to write and get,
Right, and we've actually done a lot of work of looking at that, of which funds actually remain in the top quartile going forward and things like that. And it is very rare that funds will actually be actively managed funds consistently stay in the top quartile over 20, 30, 40-year time period.
Right. Let me before I let you go, and I appreciate your time with us today. It's been very, very helpful, and I'm thrilled to have you on the show. I'm curious, just at a high level, annuities. We talk about people wanting to get more conservative. I guess one very conservative approach, forget bonds for a moment, right, would be some sort of fixed annuity. How should that play in, just at a high level, to retirement planning and spending? And if, for those that do have annuities, should that affect the asset allocation for the rest of their investments that they have?
Well, that's a two-pronged question, Rob, and they're both very good points. The first thing, I think we can touch upon how at Vanguard we believe annuities come into the financial planning picture, if at all, for retirees. And we really focus on, is a retiree looking for the guarantee, the assurance? Because, again, annuities are, and when we say annuities, we're talking income annuities, whether they're immediate income annuities or deferred annuities or longevity insurance. They guarantee against longevity risk. So the question is, as a retiree, you can do this in one of two ways. You can insure it by purchasing an income annuity to help manage that longevity risk, or you can do it with a portfolio of assets. So both are doable. The question is whether, as a retiree, do you want that peace of mind, that additional guarantee that annuities can provide, but they come at a cost, the insurance and the cost of the guarantee. We don't believe that there's an optimal annuitization ratio for retirees out there. There's a trade-off. Certainly, the more of your liquid portfolio assets you use to purchase guaranteed income, the less liquidity there would be from the portfolio later in retirement when potentially it might be needed. So we actually, if we're talking to retirees and having that discussion, we would encourage retirees to think about it in terms of what is the absolute floor, the minimum level of guarantee that you feel you need, above and beyond other sources of guaranteed income that you have as a retiree. First being Social Security. Social Security is an income annuity, and it's the safest income annuity out there because it's backed by the U.S. government. So that is the first source of guaranteed income. The question is, as a retiree, do you want an additional level of guarantee beyond that? And that's where annuities, income annuities, can come into the picture.
Okay. Am I correct that the low interest rate environment we're in makes annuities more expensive, or am I thinking about that the wrong way? And I confess I'm not at a point yet that I've had to worry about purchasing annuities or even considering whether it's the right decision for me and my family. But does the interest rate environment make annuities more expensive?
Well, it can, and there's a lot of, there's a counterpoint to all of this, and the question is, do they get more expensive relative to what? Usually that's the argument there. Trying to time annuities is a futile effort. What, as a retiree, what might be a viable strategy would be essentially maybe even dollar cost averaging into annuities. But what I mean there is potentially buying a couple deferred income annuities, for instance, if you're worried around the interest rate environment, and if you think that interest rates may go up and you may be interested in locking a higher payout, maybe buying an annuity today versus a year, 2, 3, 4 years down the road. So you can stagger the purchases out. I think it's more important to think about, do you want that guarantee, and when do you want the guarantee to start? I think that should be the first course of action for someone who's thinking about it versus trying to time when to purchase the annuity. But certainly the current interest rate environment will impact calculations that go into the payment schedule for annuities, absolutely. Okay,
well, I appreciate that. We could obviously spend an entire show on annuities, and I don't know, maybe I'll be able to convince you guys to come back and talk about annuities sometime in the future. Let me throw out one last question before we bring this episode to a close, and that is, do you have any favorite books on retirement or retirement planning that you've read, that you like, that you think those listening might be able to benefit from? And I know I'm kind of throwing that out there. Some interviewees that I talk to don't have any recommendations, and that's okay. But if you have any that you think are really good, that can help folks, we'd love to hear them.
Rob, I don't know if there's a book per se. I think there's a lot of very good information out today via the web. And rather than be biased towards one particular book, I think there's some very good personal finance columnists that tend to take different types of views, point and counterpoints. The personal finance magazines could be a really good start for retirees as well. So rather than maybe mention one book, I would actually encourage someone who's thinking about this actually looking maybe at some of the personal finance magazines that are out there.
Okay.
If I could just add to that, possibly on Vanguard.com, Marie and I have done a lot of work. There's a lot of different papers and presentations and webcasts out there that if someone was interested in reading more about it, we probably cover a lot of these topics there.
And I'll link to those in the show notes. And of course, there's the Vanguard blog. So there's that, right? So good. Okay. Well, listen, Maria and Colleen, I really appreciate your time today. Thank you so much.
Thank you, Rob.
Thank you.
Well, there you go. I hope you enjoyed the interview. Again, as always, if you have questions, there's no way we can respond to every question, every situation. I think Maria and Colleen did a great job of laying out a lot of issues. There's a lot of stuff in that interview. I mean, I've listened to it a couple of times. But if you have questions, shoot me an email, dr@DoughRoller.net. And as always, check out the show notes at DoughRoller.net/podcast 46. That's podcast followed by the number 46, where you'll see a transcript of that interview, as well as links to the various resources. So again, a big thank you to Vanguard for taking the time to do that. Now, before we go, we've got the money tip of the day, and this kind of relates to the interview. I did this on purpose, right? And it actually relates to an article that Maria wrote. But here's the money tip of the day. If you're 50 or older, some say 50 or better, but if you're 50 or older, remember to take advantage of the $1,000 IRA catch-up contribution. Right? When you're 50 or older, you can contribute more to an IRA than the young folk can. You get an extra $1,000 to your limit. Of course, there's a catch-up contribution available as well in your 401k. But let's focus on the $1,000 IRA catch-up contribution. A couple of things. You might be saying, well, Rob, everyone knows that, right? I mean, appreciate the money tip of the day, but I'm way ahead of you on that one. Well, maybe you are, and if you are, that's terrific. But Maria actually wrote an article on Vanguard that caught my attention, and it showed the percentage of people that invest with Vanguard that max out their IRA, that contribute each year the maximum amount allowed in an IRA. And when I was looking at this chart, there's a chart to this article that she wrote. And what's interesting is that you see a dip at age 50. So it starts out, folks around 20, about 25% of the Vanguard investors that have an IRA max out their IRA account each year. But that number quickly jumps to about 50% by around mid-20s, around 25. And it more or less stays at 50% all the way through to 70. It goes up a little bit, but pretty much close to around 50% of account holders max out their 401k. But at age 50, there's a pretty significant dip. And it dips for a year or two and then jumps back up. And the question was, well, why does it dip at age 50? Well, the thinking is because when you hit 50, right, the amount you can contribute, of course, goes up because of this catch-up contribution. It goes up by $1,000. And maybe there are folks, when they turn 50, either they don't know about that catch-up contribution that they're allowed, or maybe they do, but life is busy and they just forgot to ratchet up their contributions. So the tip of the day is to increase your IRA contributions if you're 50 or older, to take advantage of that $1,000 IRA catch-up contribution. Now, before I close out the money tip of the day, I'm going to ask a question, and that is, but does it really matter? So what? It's an extra $1,000. Is that a big deal? Well, it is a big deal, and we're going to take a look. Remember, if you've been following podcasts in the past, you know that I'm a big fan of Excel and formulas in Excel. You can find calculators online to do this, but I think using Excel forces you to really understand the math behind some of these calculations. And in Excel, it's extremely easy to determine just how much adding an extra $1,000 to your IRA from, say, age 50 to age 65 when you might retire, how much will that really add to your bottom line? So how would you figure that out in Excel? Well, if you open up Excel, again, above the cells, there is a box, and next to it's labeled FX. That stands for function, right? All you do is type in an equal sign, and what are we going to calculate? Well, let's think about this. We want to figure out the value of adding an extra $1,000 to our IRA for, say, about 15 years, right, from 50 to 65. So the calculation we want to know is the future value. What will the value of these $1,000 catch-up contributions be in 15 years? So our formula is equal, and then FV for future value, simple enough, and then open parentheses. And if you're in Excel, it'll then show you what information you need to put in for this formula. And the first one is the rate. What's your rate of return? Well, we're going to assume 7%, so that'll be 0.07. And then the number of periods, we'll assume 15. And then they have an option for payment. So what is the contribution we're going to be making each year? Well, $1,000. And you can also, after that, put a comma, and you can put a fourth number, and that is the present value. So I'm actually going to put $1,000 in here. And you say, well, why are you doing that, Rob? Well, I'm going to assume that we at age 50, we put in $1,000 to begin with. That's what we start with. And then starting with age 51 through 65, we add $1,000 every year. So that's what I do. So what's that going to be worth? Well, if you do the math, and with Excel, you just hit the enter button, $27,888.05. Not bad for an extra $1,000 a year once you turn 50. And that's assuming a 7% return. We can all, I guess, debate what the returns are going to be. If you could hit 10%, and I'm not saying you can, but maybe, $36,000, just under $36,000 for just making that extra $1,000 catch-up contribution. That's just the $1,000. That's not including your base contribution to your IRA. And I'll even go a step further. Imagine if you kept making those contributions. You didn't stop at 65, but you kept going until you were 70. So let's make the number of periods 20 instead of 15. Now we're looking at $64,000. So there you go, a little tip on little Excel spreadsheet 101, how to calculate future value of stream of payments. More importantly, it underscores the value of this $1,000 catch-up contribution. If you're 50 or older, if you know someone that's 50 or older, make sure they're taking advantage of that opportunity if they can. So there you go. Hope you enjoyed today's show. I certainly enjoyed bringing it to you. If you have any questions at all, shoot me an email, dr@DoughRoller.net. As I mentioned, you'll find the show notes to this episode. Just go to DoughRoller.net/podcast 46. There you go. Remember, until next time, the best thing money can buy is financial freedom.